Lots to talk about then, about the markets in 3 minutes. Mark, let's do that. And let's start with those moves in the yen. Yes, over the longer time horizon, perhaps not substantial, but it isn't usual to see moves of more than 3% in dollar yen. It doesn't happen very often, and we saw it in yesterday's session, Mark. What are you focused on here? Are you still focused on dollar yen, or are you actually looking at euro yen as we head towards the non-farm payrolls?
I'm looking at both, and let me answer that. I think that dollar yen, remember, is more importantly a dollar trade. It's a trade, and it's a dollar yields trade. And so therefore, going into non-farm payrolls, all of your volatility in that cross will come from the non-farm payrolls data and not your fundamental view on the yen. So that the move in the last kind of 48 hours has been about a change in yen fundamentals primarily. But that's not going to be the case tonight for dollar yen, so it's a bit more dangerous. If you want to sustain a view on the yen from here, euro yen is definitely the cleaner way to express it. I'm not particularly bullish yen. I'm not part of that camp. But if you are bullish yen, well, then I think many people like picking on the euro at the moment, given the soft inflation data and given the rhetoric we've had out of the ECB.
Yeah, really interesting to watch the positioning or the protection that traders seem to be putting in place around euro yen then from in and have been doing. So this is something that clearly is playing out in a big way for other assets. We've talked about how this is weighing on Japanese stocks. Let's think about the non-farm payrolls picture, though, and what we are expecting to see there, Mark. In terms of that non-farm payrolls print, I mean, we come to it with quite a bit of data on the labour market in the United States. I know you don't see the cracks in the labour market that others saw yesterday, perhaps, although you do generally see cracks when you think we're heading into a recession in the US. So all that said, what are you expecting today?
Yeah, I'm the person who thinks we're going into a hard landing. I'm the person who's biased to see softness there. But really, the softness has come from that kind of secondary data point. So I think nothing too dramatic. And in fact, continuing claims was actually lower than expected yesterday. Remember, at turning points, initial jobless claims is the single best indicator. All of them have their strengths and weaknesses, but that's the single best. And initial claims is not showing anything dramatic yet. Non-farm payrolls is probably the second best. And we are starting to see a little bit of softness there. Nothing too dramatic. As for what to expect today, I have no particular insight to diverge from the expertise of the economists out there, but I will definitely react to whether we hit or miss.
OK, and a bit of a focus on credit at this point then, Mark, just briefly. Credit badly mispriced, according to one of our colleagues.
Yeah, Tatiana Dari's put out this excellent piece. We've talked about this a couple of times this week. We had that great piece from John Authors out, and it kind of came in time for that view that I've kind of turned bearish on credit. I'm a little bit of a macro tourist when it comes to credit. Basically, credit is the most important asset class when you get to the end of the credit cycle. It becomes what every macro trader cares about. But in the kind of interim cycle, it's really a sector for credit traders, and macro guys tend to be more FX rates focused and looking at those credit indexes or equity indexes. I do think credit spreads have just got ridiculously tight, particularly in the high yield side. And I think that going into 2024, that's perhaps more vulnerable market than even stocks.